All right, so now let's discuss about one of the evaluation techniques, one of the more detailed, comprehensive valuation techniques known as discounted cash flow valuation. Um, Before we go deep into DCF technique, uh, let's uh, let's discuss how do we do analysis of a stock, and how do we decide whether to buy the stock or sell the stock. Broadly, there are two ways. One is fundamental analysis and one is technical analysis. In fundamental analysis, we look at the fundamentals of the company, like what are the growth drivers for the company, cost drivers, uh, what are other factors impacting the business, and what are the growth projections we can take, and then we decide on the fundamental value for the company. For example, let's say we are talking about Maruti Suzuki. So if I'm doing the fundamental analysis of Maruti, we can look at various aspects. Uh, what is their current market share? Um, what is their business strategy? How much are they going deep into electric vehicles? Um, what is the pricing they are doing for their products, how it is relevant for uh, the Indian consumers, and uh, what is the feedback from the dealers, what is the feedback from the customers related to their products, what is the resale value, what is the dealer network, how easily available are the parts related to the vehicle. So all these aspects, looking at all these aspects is doing a part of the fundamental analysis, right? And then deciding whether what the future looks like, what are the future cash flows we can expect, and accordingly finding the present value of those future cash flows. So that is broadly how we go about fundamental analysis. And then there is technical analysis. In technical analysis, we don't look at all this business perspective. We look at more of historical price and volume data. And by looking at those charts of historical price and volume, we figure out what uh, what can be expected in terms of share price movement, and then we can decide whether we should buy the stock at current price or not, right? So that is technical analysis. So uh, to differentiate, here we are not at all talking about technical analysis, we are focusing on fundamental analysis. And in fundamental analysis there are a lot of things, but if you look at the companies doing fundamental analysis, uh, not everybody may have this kind of bandwidth in terms of time and cost to do a very very detailed fundamental analysis, because it involves speaking to multiple stakeholders, getting their feedback, going on field, checking the on ground realities, etc. So what usually happens is that um, we we assume that all of those things are reflected in the financials, and we focus on the financial data reported by the company, and from there we do the uh, we build the models and do the DCF valuation. So present value of anticipated cash flows on an asset as determined via discounted cash flow valuation represents the asset's value. Present value of anticipated cash flows on an asset. Um, we are focusing more on the equity, but if you look at any asset, what is the returns gold is going to give me, what is the returns a bond can give me. So let's say we invest in a bond, that bond will give us coupon payments after 6 months or after every year, and finally we would be able to get the maturity value of the bond. So we can find out the present value of those future cash flows which we are anticipating from the bond to get the present value of the bond. That will be the valuation for a bond. Similarly, for stock, for a company, what are the future free cash flows the company will be able to generate, and accordingly we can figure out what is the present value of those future cash flows, and we can get an estimate of the DCF value of that stock or company. Every asset has an intrinsic value that may be calculated based on its cash flow, growth, and risk characteristics. To utilize the DCF valuation, you must estimate the asset's life, estimate the cash flows that will occur during that life, estimate the discount rate that will be used to convert those cash flows into present value. Markets are assumed to make mistakes in pricing assets across time and are assumed to correct themselves over time as new information comes out about assets. So, there is a theory of market efficiency that market is efficient and assets are priced fairly, but that rarely happens because market is driven by demand and supply, and sentiments have a huge impact on the pricing of various assets in the market. So if we assume markets are fairly pricing everything, then we don't need to do valuation. Then whatever is the price is a fair price, but that is not the reality. Markets are assumed to make mistakes in pricing assets across time and are assumed to correct themselves over the time. So there would always be some set of companies with which are in a bubble phase, which are valued in the market more than they should be, and some companies which are not the flavor currently, and those are not looked at, those are trading at a discount to the what they should be. So there would be mispricing, and that is what we can exploit by doing our valuation, trying to get a better estimate than what the market price is showing, and accordingly trading in stocks and trying to generate alpha. Next, if we look at advantages of DCF valuation, this is a very detailed approach, forces the analyst to understand the business model, its future potential, and make estimates accordingly. DCF valuation model can be built for different scenarios: bull case, bear case, base case, right? So DCF is one of the most exhaustive, one of the most comprehensive approaches of valuing any stock. Here, the analyst who is doing the DCF valuation for any company needs to understand the business model, what are the drivers of growth for that business, how is the industry positioned, what is the future prospect of this industry, is the company adapting to the change happening in the industry or not, and accordingly make estimates. So there are multiple input variables which analyst needs to take care of and make sensible, logical estimates for that. Only then the DCF value can be justified. And that valuation model can be built for different scenarios. Bull case, when the growth is more than what we expect, there is always uncertainty. So the future may turn out to be better than we thought. So that is like the bull case. Base case is what we are working with, and bear cases when the future doesn't turn out to be as good as we thought it would. So for different scenarios, we can come out with different values. Unlike relative valuation, DCF valuation is not influenced by current sentiments in the stock market. So in relative valuation, we look at what are the multiples the company is trading at in the market. Now, because of market sentiment, those multiples could look very high at a point of time, and may look very low at a other point of time, because the markets, the prices are driven a lot due to sentiments. So but here that concern is not there when we are doing the DCF valuation. It is not influenced by current sentiments in the stock market. Here we are not looking at that market data. We are analyzing the business of the company, making estimates which seem logical to us, and then we are finding out the value of the stock. We are not relying on the market data here. Disadvantages of DCF valuation: it requires the analyst to make multiple estimates, assumptions, and eventual output is very sensitive to estimates, assumptions made by the analyst. So it requires the analyst to make multiple estimates, and it is very sensitive to those estimates. So that's the issue. One of the assumptions we make is related to the revenue growth. Now, a slight change in that assumption could have a significant impact on the overall value of the company we are getting. Similarly, some assumptions like weighted average cost of capital or terminal growth rate, these assumptions make a huge difference in the overall DCF value. So that's the concern here. That's the disadvantage of this technique, that it is very sensitive to some of the estimates, and if we make those estimates wrong, if those estimates turn out to be wrong, our value and what happens in the market could be very different. These estimates may not turn out to be true due to unforeseen circumstances, over optimism, over pessimism, government regulations, policy changes, economic slowdown, pandemic, failure of management. Like we discussed, the DCF valuation models built in 2019 could have never predicted COVID. So all those estimates go for a toss because of that pandemic. Similarly, government regulation, policy changes could have a significant impact on businesses which are dependent on government regulation. For example, chemical sector is relying a lot on help from the government in terms of import duties and not allowing Chinese companies or other countries to dump their products in India. So those regulations can help these companies. But if those policy changes don't turn out to be in these companies' favor, then they may suffer a lot due to competition from other countries. So yeah, these are estimates or assumptions. They may not turn out to be true, and hence our DCF valuation could give us a very different value than future how the future stock price looks. Secondly, time consuming and requires high expertise in doing fundamental analysis, financial analysis, and building financial models. So it is comprehensive. It involves a lot of data handling, doing a lot of analysis, and building financial models. So the expertise needs to be there, and that much time needs to be devoted to do this detailed analysis. So it is not straightforward and quick. It is rather time consuming and requires skills in terms of building financial models, doing fundamental analysis, ratio analysis, and then coming out with a particular value for the stock. Okay. Some important dates related to DCF valuation. One is the valuation date. Second is the cash flow timing. The valuation date is the date we set and use for the valuation. So when are we doing the valuation? Yeah, all cash flows quantities will be adjusted to this date, right? So if we are doing valuation from on 1st April, we will adjust the cash quantities according to that date. Similarly, next is cash flow timing. These are the dates within each year when cash flows occur. We assume cash flows occur at the end of each year. Now, in reality, in business, the cash flows are occurring every day. There would be some inflows, outflows happening every business day. But practically, it is not possible to forecast cash flows for every single day. So what we do is we assume that all the cash flows for a particular year are happening at the end of the year. That is cash flow timing default assumption. But in reality, they are happening over the entire year. But for building the financial model, we assume that these cash flows are occurring at the end of the year. Other assumption we can take related to cash flow timing is mid-year convention, in which we assume that cash flows would occur in the middle of the year. So that would be more suitable, because in that case, we are not taking the start or the end. We are assuming cash flows are happening at the mid of the year. So let's say if it is January to December, we are assuming cash flows are happening on the 30th of June. That is the mid of the year rather than end of the year. Okay, so now we are discussing firm versus equity valuation. Through DCF approach, we can find out our estimate of firm value as well as equity value. Now, what is firm value? Firm value is the value of the firm. That means the entire firm. So that means this value belongs to both debt and equity, everybody. Whereas equity value is the value which belongs to only the equity capital providers. So we are distinguishing here in terms of capital providers. If we are talking about the value which belongs to only equity capital providers, that is known as equity value. Whereas if we are talking about value which belongs to both debt and equity, that is known as firm value. So we'll discuss about these both in more detail. Let's try to understand this better through how a balance sheet looks like. In the balance sheet, on one hand we have assets, and on the other side we have liabilities. Now, when we are doing valuation, we need to understand that company is a going concern. So as of now, the assets we are seeing in the balance sheet of the company, those are existing assets. They are generating cash flows today. These include fixed working capital assets, so current, non-current assets. So whatever we are seeing in the balance sheet, those assets, those are generating cash flows. Those are the existing assets. So not only that, not only will they generate the cash flows, but also the growth assets. Yeah. So growth assets are those assets which will be coming in later as investments are done by the company. For example, later the company would set up more plants, more factories. They will expand their existing operations, new geographies, new product lines. So all those would be part of the growth assets. Company is considered as a going concern. So the investment the company makes in future will also generate cash flows. So when we are looking at what are the cash flows we are going to get from the firm, those are not only from existing assets, but those are also from growth assets. So when we are doing the valuation, we consider both these cash flows, and to whom these cash flows belong. These belong to our capital providers. One of them being debt capital providers. Those debt providers, they have fixed claim on cash flows. That means they want a particular interest, and that is it. They want timely interest payments. So they have little or no role in management and fixed maturity. So they have certain defined timelines in which we need to pay down the interest and do the principal repayments and close off the debt, pay off the debt. That is their claim on the free cash flows, which are getting generated from assets in place and growth assets. So we need to pay them, and then the remaining cash flows belong to equity capital providers. They have a residual claim on cash flows, and they play a significant role in management, and their claim is perpetual. So there is no fixed maturity for equity capital providers. Equity value focuses on value, just the equity claim in the business, right? So when we are talking about firm value, we are talking about valuing the cash flows which belong to both debt and equity. When we are talking about the equity valuation only, we are talking about only those free cash flows which are left for only for equity capital providers. So after satisfying the debt capital providers, whatever free cash flows are left, those belong to equity capital providers, and those cash flows would be relevant for calculating the equity value. Let's talk about free cash flows to the firm. These free cash flows to the firm are used for firm valuation. Enterprise, whole firm we are talking about here. Cash flows considered are cash flows from assets prior to any debt payments, but after firm has reinvested to create growth assets. So here, which are the cash flows we should be considering? Those should be free cash flows to the firm. That means those cash flows belong to both debt and equity. Those cash flows which are coming in from assets in place and growth assets, and these can be distributed to both debt and equity. Those are the free cash flows to the firm. These will be used to service both debt, and remaining would go to remaining would have would belong to equity capital providers. So these are the free cash flows to the firm will use, and then these, because numerator or the free cash flows to the firm belong to both debt and equity, similarly the discounting we will do, the discount rate should also include both debt and equity. So here we are talking about discounted cash flows. So free cash flows to the firm are the cash flows, and the discounted means these should be discounted by weighted average cost of capital. That means that cost of capital which includes both cost of debt and cost of equity. So the discount rate reflects the cost of raising both debt and equity financing in proportion to their use. That is how we should do it, so that the ratio is in sync. Both these things belong to both debt and equity. Hence, we are doing firm valuation through FCFF and WACC. Present value is value of the entire firm and reflects the value of all claims on the firm, known as enterprise value. Next, we have FCFE. Here, we are talking about cash flows which are only belonging to equity holders. So after paying off the debt obligations, after satisfying the debt capital providers, whatever free cash flows are left, those belong to only equity capital providers, and we call them FCFE. Cash flows considered are cash flows from assets after debt payments and after making reinvestments needed for future growth. So again, we are considering both the assets in place, that is existing assets as well as growth assets, and the cash flows coming from those. After paying the debt payments, whatever is left, that is known as free cash flows to equity. Those are used for doing equity valuation, and from discounting perspective, we use cost of equity. Discount rate reflects only the cost of raising equity financing. So accordingly, according to the free cash flows to equity, our discount rate would be cost of equity. Present value is value of just the equity claims on the firm, known as equity value. Okay, so this is how we do the calculation. Let's see how do we calculate FCFF first. For FCFF calculation, we start with EBIT. EBIT belongs to both debt and equity. From EBIT, we pay the interest expense. We come down to net profit. We pay dividends. So EBIT is our profitability measure on which both have claim, and we are talking about free cash flows to the firm here, so EBIT is relevant. From EBIT we deduct taxes that needs to be paid definitely, so that cannot be included in the cash available for distribution, so we remove the taxes. We add back non-cash charges like depreciation, amortization. We subtract the capex because we are considering the company to be a going concern, and the company will continue to do capex, maintenance capex, growth capex to sustain in the long term, to keep on growing in the long term. So those cash flows need to be reduced because they are not available for distribution. They need to be reinvested in the organization, and plus minus working capital changes. So if there is an increase in working capital, we will do minus the increase in working capital and vice versa. So then we get to free cash flows to the firm. So after taking care of our operating expenses, after taking care of our investing activities, what we are left with is what we call as free cash flows to the firm. These are the cash flows which are available for distribution and to both debt and equity. So these free cash flows to the firm will be used for calculating the firm value. Secondly, we have free cash flows to equity. These free cash flows belong to only equity capital providers. So how do we calculate them? From free cash flows to the firm, we can remove the debt payments we need to make. So we remove the interest, and when we pay interest, we get a tax benefit because profits are reduced and we need to pay tax on lower level of profits. So that's why we get a tax benefit when we pay interest expense. So our net effective cash outflow slightly reduces because of that tax benefit. Hence we do 1 minus tax rate for the interest part, plus minus net change in debt. So then we get free cash flows to equity. And if we are using FCFE, then our denominator for discounting should be cost of equity. Next, we have projected dividends, which are also like the earnings for the equity capital providers. So in case we don't want to use FCFE for stable dividend paying companies, which are large companies which have historically paid dividends and we expect them to continue to pay dividends, for those large stable companies we can use discounting of dividends also to do their valuation. So in this case, we project the EPS. What is the future EPS we expect based on a certain growth rate, and then what is the dividend payout ratio from that EPS, how much are they going to pay, and this we can estimate from historical data. Let's say they are paying 30% as dividend, so accordingly we can forecast based on the projected EPS and based on that 30% dividend payout ratio, what is the projected dividend, and those are the expected cash flows we can expect if we hold the shares of that company. So and then we can discount those projected dividends to get a equity value. Let's look at some workings. So we have discussed about free cash flows to the firm, free cash flows to equity. So let's work on these examples to understand it better. So we are given the data for a particular company for next 5 years, and what we want to do is we want to calculate free cash flows to the firm. So we will do like what we have discussed on those similar lines only. From EBIT, we need to calculate FCFF and then find the present value of those future FCFF. So let's do it. First, we calculate NOPAT. NOPAT is nothing but net operating profit after tax. So EBIT into 1 minus tax rate. So this is net operating profit after tax. So let's calculate this. So 35, EBIT is 5,000, but net operating after reducing tax from it, after paying tax, what we are left with is only 3,500. And so future NOPAT, future net operating profit after tax is coming out to be these values. In this, we will add back depreciation because depreciation is a non-cash expense. Cash has not gone out, it is just an accounting entry. So the cash is still with us. That's why we are adding it back, because it was already deducted while calculating EBIT. Increase in net working capital. So here we can see at the end of year 1, net working capital has increased by 100. That means some of our cash got consumed there in the working capital. So the increase in net working capital should be less. So we will do minus 100 when we are doing the FCF calculation, because this is the increase in working capital. If working capital has increased from 1200 to 1300, that means 100 of our free cash flow got blocked here. So our free cash flow to the firm reduces because some cash is getting blocked here. So that's why we will do less of increase in working capital and less of capex, because we need to invest, we need to keep on investing for future sustainability and growth. So these cash flows, this much amount of cash flows are also expected to be blocked or consumed, and hence what we are left with is only 3,500 plus 300 less 100 less this. So we are left with is only 3,200, right? So from NOPAT, we have added back the depreciation, less increase in net working capital changes, less capex, and that gives us free cash flows to the firm. So we have calculated the free cash flows to the firm for the next 5 years. This is how we do the DCF valuation of the company, where we project the future free cash flows to the firm and then we discount it back to get the present value. Now, in this case, we are only doing it for 5 years, but that does not mean that the company will stop growing. The company will continue to exist, but here in this example, we are not considering that, but in future examples, we'll consider that also. Now we want to calculate the present value of future free cash flows to the firm. So what we'll do is we'll calculate the discount value factor to calculate the PV of future cash flows to the firm. Because we are talking about free cash flows to the firm, so our discount rate should be WACC. That's why in the discount value factor calculation, we'll take the discount rate as WACC. So the present value of future free cash flows would be discount value factor into free cash flows to the firm. And we can do the sum of this to find out the sum of PV of future free cash flows to the firm. So this is how we calculate free cash flows to the firm and present value of future free cash flows. Let's look at another example now in which we are calculating free cash flows to equity. Okay, here we are talking about those free cash flows which belong only to equity capital providers. So let's do the calculation for those. First we calculate NOPAT, which is nothing but EBIT into 1 minus tax rate, net operating profit after tax. So from the operating profit, we will remove the tax. This will go to the government. So what we are left with is only this much. We add back depreciation because this is a non-cash expense. We will do less of increase in working capital. So what is the increase in net working capital? This much. And we'll do less of capex. What is capex? This much. So FCFF would be NOPAT plus depreciation minus increase in working capital minus capex. So these are the future free cash flows to the firm based on this data. But we want free cash flows to equity. So from here, we will reduce the debt. What should go to the debt providers? After reducing their claim, whatever is left would be considered as free cash flows to equity. So here we'll do less of interest into 1 minus tax rate. Interest expense into 1 minus tax rate because we get tax benefit here. That's why we are doing 1 minus tax rate. So when I am paying 20 as interest expense, the reduction in cash is only 14 because 6 is the tax benefit. I have to pay lesser tax. So effective net outflow reduces. Less of debt repayment. If we are repaying debt, that cash flow is getting consumed there, so remaining will be less. So what is the repayment? Here we have done 20 as the repayment, so we will do less of this. So it will be FCFF less interest, less of repayments. So this is free cash flows to equity now. Again, if we want to calculate the present value, then we will first find out the discount value factor for different periods. So here, the discount value factor should not be WACC, it should be cost of equity. Yeah, when we are discounting the free cash flows to equity, then we should use cost of equity as our discount value factor. And then to calculate the present value, we will multiply the discount value factor with the actual value. This is the PV of future FCFE, and we can find out the sum of PV of future free cash flows to equity. So this is our sum of PV of future FCFE. Yeah, so now let's look at various steps involved in doing the DCF valuation for a firm. Now, step 1 is projection of financial statements data to get projected free cash flows. So, how we do it from the scratch, how we start is we can look at the financial statements data. So, again, lot of estimates need to be made on income statement data, balance sheet, cash flows, and those projections, those estimates could be on the basis of how we see the business, how do we see the industry, how do we see the economy in which the company is operating, how is company going to be positioned in the market as compared to competitors, from where the growth is expected to come, which geographies, which products, what is the R&D expenditure expected, selling marketing expenditure, what is the capex expected. So lot of assumptions, lot of projections, lot of estimates are being made here, and finally we get to free cash flows, right? So we will look at how the EBIT is expected to turn out, tax rate, depreciation, amortization, working capital changes, capital expenditure, capex. We will figure out the forecast for all these items to forecast the free cash flows to the firm or free cash flows to equity. We will project the free cash flows as part of step 1. Step 2 is calculation of discount rate, WACC or cost of equity depending upon which cash flows we are discounting, right? So step 2 is, because we are talking about discounted cash flows, so what should be the discount rate? We have calculated the free cash flows, but if we are using free cash flows to the firm, then our discount rate should be WACC, because both free cash flows to the firm and WACC belong to both debt and equity. So that is why, to keep it in sync, if our free cash flows are FCFF, then our discount rate should be WACC. And secondly, if our free cash flows are FCFE, then our discount rate should be cost of equity. Now, there are various things we take into consideration while calculating WACC or cost of equity. We will discuss them in more detail later on in the video. But just to give you a brief idea, WACC is weighted average cost of capital. So we consider the weight of debt into cost of debt plus weight of equity into cost of equity to calculate WACC. So it is the weighted average cost of debt and equity um, based on the capital structure of the company. Cost of equity is higher than the cost of debt because equity is considered to be more risky than debt. Uh, in case of liquidation or bankruptcy, debt holders have the first claim for the cash flows, and equity holders have the last claim on cash flows. So that's why investing in equity is more risky, uh, considered to be more risky than investing in debt or bonds of the company. Um, Cost of equity. Again, there are various ways to calculate cost of equity, but broadly it represents what is the expected rate of return of equity investors. And if we are using FCFE as the free cash flows, then we should use cost of equity as the discount rate. Step 3 is calculation of terminal value with perpetual growth method or exit multiple approach. So um, when we are doing the projections, we cannot do the projections till infinity. So what we do is we assume that the company will grow at a particular rate for next few years, and eventually it would stabilize. It would start growing at the growth rate of the economy or slightly lower than the uh, economic growth rate, because we cannot expect a company to keep on growing at a very high rate. So if the company is already in the maturity stage or uh, has reached saturation in terms of its products or services, that company can only grow at economic growth rate or slightly lower than that. But for companies which are relatively new in terms of their business model, uh, they could grow faster, but eventually for those companies also competition will kick in. The pricing power will reduce, the competitive advantage will fade away, and slowly they will also stabilize. Their growth would also not be as much as it was in the early stages, and eventually they would also become mature companies, stable companies with a stable expected growth rate. So forecast we make would be like one is for the explicit forecast period. So maybe we are assuming that for next 5 years the company will grow slightly faster. So we are making the estimates for next 5 years, and then we assume the company to grow at a particular small growth rate till infinity. So that period, after the explicit forecast period, uh, from the end of the explicit forecast period till infinity, the company is still working in that period, growing at a stable growth rate. That value is captured through terminal value, right? So whatever cash flows the company is going to generate after the free cash flows, after the explicit forecast period, the present value of all those cash flows um, is the um, terminal value. That is the value which the company will have at the end of the explicit forecast period, considering all the free cash flows which are happening beyond the explicit forecast period. And we can do the calculation of terminal value through perpetual growth method or through exit multiple approach. We will again look at both of these in more detail later. Um, Step 4 is to discount the projected cash flows calculated in step 1 and terminal value calculated in step 2 using discount rate which we have calculated in step 2. Terminal value growth rate is again very subjective, very debatable. What should be the growth rate we are assuming for the terminal value? And it can have a significant impact on the terminal value, right? So after the explicit forecast period, what is the growth rate we are assuming till infinity? Because we are talking about till infinity, so that growth rate can have a significant impact on the overall value of the company, and terminal value in itself is usually a very large portion of the overall value of the firm we are going to get. So that terminal growth rate has to be very carefully chosen. It should not be more than the economic growth rate, and it can depend on where the company is operating. For example, if the company is operating only in US, majority of their operations is only in US, then probably we can use 2% as the terminal growth rate. Whereas if 50%, 60% of the operations of the company is in a country like India and the remaining operations are in US, then we can assume a slightly higher growth rate, taking into account that Indian economy is expected to grow faster for longer because of the demography and because of other factors. That is more of a developing economy. So it will grow at a faster rate than as compared to a developed economy. So then the discount terminal growth rate could be 3, 4, 5% based on where the company's operations are and from which economies the company is generating the revenue. So accordingly, we can decide the terminal growth rate. Finally, step 5 is the DCF value, which is the sum of PV of projected cash flows and PV of terminal value. So all the projections we have done for the explicit forecast period, sum of PV of all those values and the terminal value which we got at the end of the terminal period, explicit forecast period, the PV of that terminal value, we will add these two to get the total PV of all the cash flows, and that will become our DCF value. Okay, so we are going to do this. We'll discuss this through the help of an example, but these are the broad steps we follow for doing DCF valuation. Quickly revisiting them. First, we project the free cash flows to the firm or to equity. Then we calculate the discounting factor, which could be WACC or cost of equity. Then we calculate the terminal value, either using perpetual growth method or exit multiple approach. Then we discount the projected cash flows, which we calculated in step 1, and terminal value, which we calculated in step 3, using discount rate, which we calculated in step 2. Finally, the DCF value is the sum of PV of projected cash flows during the explicit forecast period and PV of terminal value at the end of the projected explicit forecast period. To look at it more graphically, let's discuss this. This is how DCF valuation model is working. We want to calculate the value of the firm in today's terms. So here we are standing and we are looking at projected free cash flows for the explicit forecast period. We have projected the free cash flows during the end of period 1, period 2, period 3, 4, 5 till n. This is the length of the period of high growth. So again, it could vary from company to company. For a large stable company, this could be a very short period, and then we will assume it will grow at a constant rate forever. Whereas for high growth company, which is currently niche in the business and expected to grow faster, then for those companies, for example, let's say we have Zomato or Birla Opus just entering into the business, or these kind of business models which are relatively new, where the market capture is yet to happen, so we can expect a higher growth for longer. In those cases we can make explicit forecast for longer, and then eventually for those companies also we will assume that they will grow at a constant growth rate forever. So our length of explicit forecast period can vary based on company to company. Here we are talking about cash flows. It could be for the firm or it could be for equity. So pre-debt cash flows or free cash flows to the firm, it could be those cash flows, or it could be equity cash flows only, that is after debt cash flows, free cash flows to equity. These cash flows, as of now, we expect them to grow a slightly high. This is the high growth period. So we will, if we are talking about free cash flows to the firm, will be more focused on growth in operating earnings, no PAT, because no PAT belongs to both debt and equity. And if we are talking about expected growth for free cash flows to the firm, no PAT becomes more relevant. And if we are talking about free cash flows to equity, then we'll focus more on in terms of growth in net income or EPS. Accordingly, based on which cash flows we are talking about, is it FCFF or is it just to equity, that is FCFE, our discount rate would also be based on that. If FCFF we are using, we will use cost of capital, which is our WACC, and if we are talking about FCFE, then our discount rate will be cost of equity. And eventually we will assume that after the explicit forecast period, the company will continue to grow at a constant rate forever, and till infinity it will continue to grow at a constant rate. So this is our long-term growth rate or terminal growth rate. This can have a significant impact on the overall DCF value we get for the firm, and this should not be greater than the economic growth rate. Next, let's talk specifically about firm valuation now. We want to value a firm. So how do we go about doing it in terms of DCF valuation? We calculate the free cash flows to the firm for different periods. Because we are talking about firm valuation, hence we will take here the free cash flows to the firm. So free cash flows to the firm at the end of year 1, 2, 3, 4, 5 till n. So this is our explicit forecast period, and then eventually we will assume that after this the company will continue to grow at a constant rate till infinity. So we will calculate our terminal value here. Free cash flows to the firm, as we have seen previously, are calculated as no PAT, which is EBIT into 1 minus tax rate minus capex plus depreciation minus increase in net working capital. That will give us free cash flows to the firm, which we are going to forecast for explicit period, and then we will calculate the terminal value for all the free cash flows to the firm we are going to get after the explicit forecast period till infinity. those will be captured in the terminal value of the company, which will be calculated as free cash flows to the firm for the period next to the uh, ending period of explicit forecast period, FCFF, for period n plus 1, divided by WACC minus long-term growth rate, um, that is weighted average cost of capital, minus long-term growth rate, which can be taken as economic growth rate for that economy in which the company is operating. So this will give us the terminal value at the end of period n, and we will discount back both these free cash flows to the firm and the terminal value by using the discount rate of WACC, which is our weighted average cost of capital, which is calculated as cost of equity into weight of equity plus cost of debt into weight of debt. Cost of equity is calculated as through capital asset pricing model. It is calculated as risk-free rate, that is the rate of return we can expect without, if we uh, if we do not assume any risk, what is the rate of return still we can get. For example, if we are investing in government bonds, we expect them to be safe, so the return they are providing can be considered as the risk-free rate plus beta into equity market risk premium. Beta is a measure of stocks volatility relative to the market into equity market risk premium, that is the extra return we want because we have invested in the market, because we have taken the risk of investing in the equity markets. So what is the extra return we want because of that extra risk we are taking? So that is equity market risk premium. We will talk more about how do we go about calculating cost of equity, cost of debt, and WACC. But this was the brief that we calculate free cash flows to the firm, we calculate the terminal value, and then we discount all these through the discount rate of weighted average cost of capital, that is WACC. Let's look at an example to understand this better. Here we want to calculate the value of the firm. So let's do this. We are given with some projections for future years, and the company is not going to stop after 5 years, so we need to consider what's expected to happen after 5 years also, which will give us a good estimate of the current value of the firm using DCF technique. So this is like a brief summary of how do we go about valuing a firm using DCF technique. So we have made these estimates. Now based on these estimates, let's calculate the free cash flows to the firm. We start with NOPAT, which is EBIT into 1 minus tax rate. We will add back depreciation because it is a non-cash expense. We will less the increase in net working capital. So let's see what is the increase in net working capital. And we will less the capex. So what is the capex? So we'll do NOPAT plus depreciation, less increase in working capital, less capex. This will give us free cash flows to the firm. This is our explicit forecast period. So we are making projections, forecast for next 5 years. but the company is considered to be a going concern. That means company will not stop working after 5 years. The company will keep on generating free cash flows to the firm till infinity. So that means free cash flows to the firm will keep on getting generated till infinity. So we cannot ignore this value. We cannot ignore these free cash flows. But at the same time, we cannot make forecast till infinity. So that's where we stop at explicit forecast period and assume that the company keeps on growing at a constant long-term growth rate. Okay. This is our assumption for long-term growth rate, 6%. So that means we will find out the value of all these cash flows, and that will be our terminal value. The value of all those cash flows at the end of period 5, this value would be the terminal value. But first of all, let's calculate the present value of all those free cash flows to the firm which we expect to get generated in the explicit forecast period. So to calculate the present value, we'll look at the discount value factor. Because we are talking about free cash flows to the firm, hence our discount rate would be WACC. And that is how we calculate the discount value factors. And this will give us the present value of explicit future cash flows by multiplying the discount value factor with the FCFF value. So the sum of the PV of all the FCFF in the explicit forecast period is coming out to be 18,093.5. But the firm is not stopping here. It will continue to grow. So we need to calculate the terminal value also. So for all the free cash flows which are going to happen after the explicit forecast period, we need to calculate their value, which we call as terminal value, which will be calculated as free cash flow for the last projected year into 1 plus long-term growth rate divided by WACC minus growth rate. So this is the Gordon growth model where we are assuming a constant growth till infinity, and then we are finding the present value of that perpetual annuity. And this is the value at the end of year 5. So we need to bring it back to present value, which we can do by multiplying this by discount value factor for year 5. So this is the present value of all the free cash flows which are expected to happen during the explicit forecast period. And this is the present value of terminal value, and the value of the firm will be the sum of this and this. This is how we get to the firm value. Next, we have equity valuation with FCFE. Here, we are talking about equity value. So, we will be using free cash flows to equity now. So, free cash flows to equity will be projected for the explicit forecast period and assumed to grow forever till infinity. And these free cash flows to equity will be discounted by now cost of equity, not cost of capital, because these are free cash flows to equity. Hence, to make sure that the denominator is also in sync, we use the discount rate as cost of equity. And what we get is the value of equity. So all these are the free cash flows to equity, which are expected to grow. For some period, we are projecting the growth, but after that, we will assume them to grow forever at a constant rate, which should be equal to or lower than the economic growth rate in which the company is operating. And cost of equity will be calculated through risk-free rate plus beta into market risk, equity risk premium. Similarly, we can also do equity valuation with dividends. So here we project the dividends, we forecast the dividends, and then we expect the dividends to continue to grow at a constant growth rate. And then we use the discount rate as cost of equity again, because these are cash flows to equity. So very similar, just that rather than FCFE, we are projecting the expected dividends as the returns for equity holders. Let's look at a working now, which is let's look at an example where we need to calculate the equity value. That is, we need to calculate per share value. What should be the intrinsic value of one share of this company which has these projected financial numbers? So for such a company, what do? We first calculate the free cash flows to firm, then we will calculate value of the firm, from that we'll calculate value of equity, and then from that we'll calculate value per share. First we'll calculate NOPAT, which is EBIT minus tax rate. Add back depreciation. Increase in working capital. And capex. This will give us FCFF. To discount these FCFF values, we'll use the discount value factor. And multiply these with values to get the present value. And we can get the sum of these present values. So this is the present value, sum of present value of explicit future free cash flows to the firm. From free cash flows to the firm, we will get value of firm. And that is why we are using WACC as the discount rate. Let's calculate the terminal value, which is the value at the end of the explicit period of all the cash flows, free cash flows that are expected to occur after the explicit forecast period till infinity. Using Gordon growth model, we calculate it as FCFF into 1 plus long-term growth rate divided by WACC minus long-term growth rate. Present value of terminal value will be equal to this into, so the value of firm would be, right, this is the value of the firm based on free cash flows during the explicit forecast period, and beyond that, from here we will calculate the value of equity by adding cash investments less debt the debt, minority interest. So this is how we'll get the value of equity, value of firm plus cash plus investments minus debt and minus minority interest. So from here we will divide it by the number of shares outstanding. We have to calculate the value per share. Right? So this is how we can get to equity value per share. According to us, this represents the intrinsic value per share according to the DCF technique, which relies on estimates made by the analyst. Right? So this is the intrinsic value. We will compare it with current market price. Let's say current market price is 600. In that case, we will say this share is overvalued in the market. According to us, the value should be 530 only, but it is trading at 600. So we'll say it is overvalued. And if it is trading at 400, we will say this is undervalued in the market. For overvalued, we will give a sell recommendation. For undervalued, we will give a buy recommendation. And if the value is close to the current market price, we will say hold. Okay. It is fairly valued, and we will give a recommendation of hold. All right. Next, let's look at some other important things we need to take care of while doing the DCF valuation. First is explicit projections period. Now, when we are doing the projections, what is the explicit forecast period we should take? Should be 5 years, should be 3 years, should be 2 years, should be 7 years, should be 10 years. That is also subjective and it is up to the analyst, but there are few pointers which we can use while deciding the explicit forecast period. Typically, we make the explicit forecasts over a 5 to 10 year horizon. This presupposes that the company will transition into a phase of stable growth during this lifetime. Reasoning behind it is observing the growth trajectories of publicly traded firms, especially those with readily available historical data, reveals a common trend. The majority of these companies tend to reach a point of growth saturation within the 5-10 year time span. So, this observation that we should forecast it for 5 to 10 years is based on the data. Sustaining rapid growth over an extended period becomes increasingly challenging for a company as it expands. With growth, the company's overall size increases, making it progressively harder to achieve the same level of high growth as when it was smaller. This phenomena is often referred to as the base effect, and it naturally leads to a slowdown in growth over time. So, um, let's take the example of HDFC Bank, huge bank having branches all over India, huge number of customers already, making huge profits. Now, can we expect HDFC Bank to grow at 20-25%? No, they already have expanded a lot. So the base um, is already at a very high level. Growing at that base at 20% is not practically feasible. So similarly, let's say Reliance, with that base we cannot assume it to grow at a very large pace. Then such firms tend to normalize in terms of growth of their earnings, and hence we should not expect them to keep growing at a much higher rate. Unless a company possesses significant barriers to entry for potential competitors, intense competition can hinder the continuation of sustained growth. So, let's say there is a company which has competitive advantage and there are significant barriers to entry, but if that company makes huge profits, other competitors will come in. There would be some other big players who would definitely like to take a portion of those huge profits. So competition increases, pricing power decreases, customers get bifurcated. So that growth which was happening earlier, that profit margins which were happening earlier may not happen. Hence also the growth slows down. In certain situations, an extended projection period which extends beyond the typical 10-year horizon can be justified, especially when evaluating a relatively young company. So, in some cases, when we are talking about very unique young businesses, then we can think of doing the projections for more than 10 years. But these would be rare. Operating within a niche industry, established and proven business model, barriers to entry. So, like we have some examples, like we can say Zomato, Paytm, these new age tech businesses. These are relatively new from the Indian perspective. If we see specifically, these are good, solid tech businesses which we have, and there is not that much penetration. So they have relatively clear runway for few more years, and then obviously maybe more competitors will come in, or their scale will become so large that they cannot grow at a higher rate. But definitely for such businesses, we can expect a higher growth rate for more than 10 years, and then we can expect them to stabilize at a constant long-term growth rate. On the flip side, when dealing with companies that have already reached maturity or are rapidly approaching that stage, projecting their performance over a lengthy 5-10 year period may not be necessary. So in some cases, we may not even do 5-10 years for the companies which have already reached maturity or are rapidly approaching that stage, right? So, for example, huge FMCG companies like um, HUL, Nestle, um, we cannot expect them to have a high growth rate for 10 years. So maybe a shorter projections period is warranted in such cases. Okay. Let's look at ways of estimating terminal value now. As we discussed, terminal value is a significant portion of the overall value of the firm, and estimating terminal value becomes very important because this can significantly impact the overall value of the firm we get. There are various ways to do it. One is liquidation value, most useful when assets are separable and marketable. So liquidation value um, is not that frequently used because we expect the company to be a going concern. But in case we are valuing it from the perspective that uh, company will cease to exist after that, it will liquidate, then we can calculate the liquidation value uh, to calculate the terminal value. So only in specific cases, but in general, we consider the companies to be a going concern, and hence this will not be used. Broadly, mostly we use two ways to calculate the terminal value. One is the multiples approach and the other one is Gordon growth model. We have seen Gordon growth model in which we assumed that the company from here on will continue to grow at a particular long-term growth rate. Like here we saw that after this, the company will grow at a long-term growth rate of 6% till infinity. So this is Gordon growth model, and according to the Gordon growth model, we calculated the terminal value. FCFF of the first projected year, that is last into 1 plus long-term growth rate upon WACC minus long-term growth rate. This is the Gordon growth model to calculate the terminal value. Second one is multiples approach, in which we expect it to have a particular value based on the multiple. For example, I can say the value would be 10x the NOPAT, right? So in this case, how am I calculating the terminal value? Terminal value will be 10 times the NOPAT for this year. So this will be the terminal value. So here we have were considering the multiple, that after the explicit forecast period, it will be valued at 10x the NOPAT. This is more relevant in cases where PE firm is planning to exit their investment. So they look at things more from the exit multiple perspective. That's why this approach is more relevant in such cases. Getting terminal value right. When a firm's cash flows grow at a constant rate forever, the present value of those. So this is what we saw in our Gordon growth model. Expected free cash flow next period divided by discount rate minus the growth rate. The steady growth rate, this G, the expected long-term growth rate, may be set lower but cannot be greater than the economic growth rate. If you assume that the economy is composed of high growth and stable growth firms, the growth rate of the latter will probably be lower than the growth rate of the economy. The stable growth rate can be negative, the terminal value will be lower, and you're assuming that your firm will disappear over time. If you use nominal cash flows and discount rates, the growth rate should be nominal in the currency in which the value is denominated. We use nominal cash flows and rates across for consistency. So uh, we always use nominal cash flows and nominal discount rates. Um, and the growth rate can be negative, but this would be rare. In this case, we are assuming that company is on the declining trend and it will cease to exist after a certain time. So not a scenario which is used often. Yeah. Okay. Few more points related to stock-based compensation now. Should SBC be added back while calculating FCFF, considering they are non-cash expenses? Yeah, this is we see in companies like Amazon, more common in US-based companies where they offer a lot of stock-based compensation. Should it be added back while calculating FCFF, considering it is non-cash expense? Stock-based compensation expense represents a business cost incurred by the company when it issues stock to its employees in lieu of cash payments. Therefore, although SBC expenses are non-cash and do not directly affect cash flows, they lead to future dilution of shares. When these stock-based compensation will be realized by the employees, it will result in the increase in the number of shares outstanding. So it will result in dilution of shares. So while SBC does not require any cash, it does have a capital structure impact on the business since the number of shares outstanding increases. Yes, because so capital structure would get impacted because equity is getting impacted. When we include SBC in the calculation of projected free cash flows to the firm, we are essentially assuming that being a non-cash expense, it will not negatively impact the company's cash flows and therefore it will have no effect on the DCF value. While this assumption is correct in the sense that SBC does not directly impact cash flows, it is incorrect in the aspect of its impact on the DCF value of shares, because in reality, the DCF value of each existing share will come down because of potential dilutive effect of these securities. So when we are doing the DCF valuation, there are two ways to handle SBC. One is treat the expense as a cash item, don't add it back. Or take into effect the dilution, add it back and increase the number of shares outstanding by the number of shares awarded to employees, both vested and non-vested. So either we adjust both the numerator and denominator, we are adding back and then increasing the number of shares outstanding, or we don't add it back and let it be. The final output of the DCF calculation is as follows. DCF value per share is DCF value of equity upon diluted number of shares outstanding. Adding back SBC expenses does increase the DCF value of equity, but it also results in a higher number of shares in the denominator of the equation, effectively offsetting the increase in cash value in the numerator. In practice, it is challenging to accurately adjust the denominator, that is the diluted number of shares, to account for the dilution caused by future SBC expenses issued to employees. Therefore, by not adding SBC expenses to FCFF, we balance the effect of not incorporating the dilution caused by these future SBC expenses into our valuation. Next, we will look at consolidated and standalone results. So in companies which have invested in other companies and have more than 50% stake in other companies, they will present both their consolidated results and standalone results. Consolidated statements include the financial data from a parent company and its subsidiaries. When there is 50% or more ownership or investment, that company will show standalone and consolidated both data. If both parent company and subsidiary are operating in the same industry, consolidated results are used for valuation purpose. So if we are looking at companies which have invested into other companies more than 50% stake, and those subsidiary companies also operate in the same business as the parent company, then we are fine to go ahead and look at the consolidated results directly. But if the subsidiary companies into different business, then we should value them separately. Then we should do more of a sum of parts valuation. Financial statements that include financial performance and position of a company without taking into account the effects of any subsidiary companies, those financial statements are known as standalone results. When there is less than 50% of investment of a company into subsidiary, that company shows that as an investment in the balance sheet on the asset side. So let's say a company owns 20% stake in another company or 30% stake, that is less than 50%, then they can simply show it as an investment in the asset side of the balance sheet. If both parent and subsidiary companies are operating in different industries, standalone results of both are used. So then we should look at standalone results of parent and standalone results of the subsidiary company and then do the valuation because they are operating in different industries. Next important account which we need to take care of is minority interest. It refers to the non-controlling interest. So that means, let's say company A owns 80% stake in company B. So that remaining 20% interest is the interest which somebody else is holding. Company A is not holding. So that is the non-controlling interest, and that is known as the minority interest. It is a percentage of subsidiary stock that the parent firm does not possess. The minority interest needs to be taken into account when valuing a firm. There are few reasons of why do we add minority interest in the So we add minority interest in the calculation of enterprise value. Why do we do that? If a company holds over 50% equity in another company, then that company is considered a subsidiary of the parent company. The parent company is obligated to incorporate 100% of subsidiaries' assets, liabilities, revenue, expenses, and cash flow into its financial statements. So when the parent company is showing its consolidated results, it will include 100% of the subsidiaries' assets, liabilities, revenue, expense, cash. But in reality, it might be owning only 80%, right? But that remaining 20% is the minority interest. This implies that all financial metrics at the parent company level, such as sales, EBIT, EBITDA, NOPAT, FCFF for the parent company, encompass 100% of the company's corresponding figures from the subsidiary. So let's look at this example of consolidated income statement. So we have some income statement data here for the holding company and for the subsidiary. So when holding company or the parent company is showing its consolidated results, it will show like this. It will include 100% of subsidiaries revenue as well. So let's assume in this case, holding company is owning 90% stake of subsidiary. So they don't own 100% of subsidiary. They own only 90%, but still when they are presenting the consolidated financial statements, they will add 100% of revenue, 100% of expenses. So accordingly, net income is shown as this much, but 10% is not owned by the parent company. So 10% of subsidiaries income belongs to minority shareholders. So only this much, minus 325 minus 14.5, that is 310.5, is available to common shareholders of the holding company. So this is how consolidation of income statement happens. We show it as 100% and then we reduce the net income of the subsidiary company which belongs to minority shareholders to come to the net net income available to common shareholders of the parent company. How do we build the consolidated balance sheet? So in this case, this is the liability side. Liability in terms of equity, debt, and this is the asset side of the balance sheet. Here we have assets, current assets. So what do we do here is, on the asset side of the balance sheet, that means we are talking about this side of the balance sheet, we can see that holding company $567 million investment in the subsidiary. So holding company has invested this much in the subsidiary company, and this is 90% of equity of the subsidiary company. So 90% of 630, that is the investment done by the holding company in the subsidiary company. So we will show it in the holding company's balance sheet. In the standalone, we will show it as investment in subsidiary. But how do we do consolidated? We do not add this here, right? So consolidated includes 100% of current assets, long-term assets of subsidiary and the holding company. This will give us the total assets of the holding company's consolidated financial statements. To counteract this, so here 567 we have not added, right? So now to counteract this, on the liability side, 90% of subsidiaries equity is removed. So this much of equity, 90% of subsidiaries equity is also not taken into account. We only take into account 10% of subsidiaries equity. Balance 10% equity of subsidiary company not owned by the holding company is shown as minority interest. So this minority interest is only 10% of subsidiaries equity. We have not taken into account 90% of subsidiaries equity here, and we also did not take into account 90% of subsidiaries equity investment in the consolidated financial statements of the parent company. All other items are added on 100% basis in consolidated balance sheet, say long-term assets, current assets, total debt and creditors.